I'm Arjun here. And it's Friday afternoon, so it looks like our attendance is not very high, but still a smaller audience, we can have a wider discussion. Coming back to the markets itself, today our agenda will be, we will have an overlook. What are the headwinds facing the markets? The second is credit market outlook, and the third is where to invest. Now, as most of you have been following INR bonds for the last many years, but even if you're more recently, if you've been following INR bonds, you must have seen that we have been very negative on uh, yields over the last 1.5 years. And we have been cautious and almost warning investors and financial advisors about the potential rise in yields. And at that point of time, typically when there was so much of money uh, floating around, central banks were throwing in money to the markets. Rates were at record lows, all kinds of support coming in. Then you had COVID, the first wave, second wave, etc. So and RBI supporting in India itself, RBI supporting GSEC yields. In fact, they held the GSEC yield for about 10 years for 6% for a longer period of time, right? So that sends false signals to markets and investors. And if you really look at it, in the last 1.5 years, with a huge borrowing program, with a huge amount of money raised through bonds, uh, a lot of investors have logged into money, which is about 1.5% lower than where they are now. And if they rise further and stay higher, that means that money locked in is earning so much less, earning so much less than inflation as well. And no, you can't even sell that because the losses would be very high. And holding a long bond, if you're an investor, unless you're a PF or an LIC, then it's not an ideal situation for investors, right? So you'll have to wait for the bonds to mature. By the time the bonds mature, the amount of earnings you'll earn will be so less that you would have actually that the time to make up this kind of loss and opportunity is going to be very high, right? Um, hence, the we have from the time GSEC was 6%, so we had called at 6.5, 7%, 7.5, and now we are saying 8%. And clearly, 10-year GSEC is at 7.5%, and from 7.5 to 8% is not very far away. But having said that, the question is, what is the next? Where next? Are these the peak levels of yields or more to go? Should investors invest here now, or they should continue to be very safe? But at the same time, we were always saying that credit markets were looking good because the economy was picking up, and there was a lot of uh, interest in yields also for investors. So you had the lower rated bonds, which is say below AAA, doing extremely well. So in our own uh, platform, we have seen all the bonds that have been traded at over 8.5%, outperforming all the other uh, product benchmarks, from GSEX to Bharat Bond, ETF to mutual funds, by about 4 to 5%, which is a huge margin because none of these bonds have lost in terms of yields. So clearly, the spreads were very wide at that point of time. And if you could identify short maturity bonds in a 2 to 3 year kind of investment frame, in fact, the spreads have come off sharply. So investors have gained over that. Again, the question comes back is, look that to the past. So from here, will the spreads actually come back, or will the spreads go up? Clearly, if the spreads are looking to go up, then it's not a great investment to be in. The spreads are looking to go down, then you can look to definitely invest in that. So coming back to the agenda today, let's just take a quick look at the overlook on the markets. So what are the markets telling us now? Clearly that there is a lot of uh, uncertainty on the fixed income side. And we all know, again, you have been following INR bonds, you have been following a lot of other uh, news as well, and information. We all know that by now, inflation is like taken over the world. The Federal Reserve is raising rates. The ECB will start raising rates soon. All of them are ending bond purchases. RBI started to raise rates. Inflation forecasts are higher. I'll not really go into too much of that because it's we have been putting out enough material on that as well, and uh, it's been it's the theme. So everywhere the way looking at that, it's not really looking good. But what when I hear the Fed speak or the ECB, even the RBI, all of them are attributing inflation to various sources. Yes, supply constraint, maybe food prices, fuel prices, right? But none of them have actually told us that it's because of excessive money printing. And to a very large extent, you must, and central banks themselves know. Just one sec. Sorry. If I'm not very loud, please let me know. Nikhil, you can just shout out.
Yeah.
Uh, so central bank themselves, none of them have actually said it's because of excessive money printing, because they don't want to admit it. And second is, if they start to admit it and panic, then the markets will fall much sharper than where it has fallen. So already you have panic in equities. You have seen the technology stocks fall very sharply, and there have been a lot of charts that saying how much technology stocks depend on central bank largesses, right? And you had a whole host of money going into fintech and other startups and VC venture funding, etc. at absurd, very high valuations. All that has really fallen off now. And then you had the new age currencies like cryptos, again seeing a huge jump, then just fallen by the wayside. So losses have been phenomenal. Okay. Typically, in such markets, there's a huge amount of leverage. So if you take the US junk bond and Euro junk bond yield, they have fallen to they have fallen to record lows, almost 4% they were actually, before they have climbed up again. And uh, uh, the spreads too. So wherever the markets found some yields, they were taking it, but that's no longer happening. So it's not a great outlook is of risk aversion. Nobody wants to take risk anywhere, including fixed income. The biggest risk, as INR bonds I have been continuously saying, is the risk of the government bonds, and I continue to see that risk. It's going to be it's still very high because they are nowhere in comparison to where the yields inflation is. And second is governments have borrowed too heavily, so they have to keep on borrowing more and more just to repay interest and keep the uh, at least some levels of spending going. So that's not going to come off at all. And central banks were hoping that a higher economic growth can pull down the fiscal deficit, as well as enable governments to pay down debt. Uh, but if you really look at it, to some extent, if you look at India's nominal GDP for 2000 last year, that is 21-22, it was close to 20%, 19.5%. The original forecast were closer to around 12.5 to 13%, or slightly higher. So clearly, high inflation is good for bringing down fiscal deficit, and central banks are aware of this. But having said that, it's just a matter of a relative number because it's percentage to GDP and not absolute levels of borrowing. So in India, the borrowing has record high this year. Central government plus state governments, and plus if you take the current levels of subsidies that needs to be borrowed, it will touch closer to can go over, well over 20 lakh crores. That's very huge amount of borrowing. Where is the money to fund that supply? And RBI will have to buy bonds. But if they do buy bonds, that means they're adding more money into the system. And when they add more money into the system, it's highly inflationary as well. And they cannot continue to sell dollars to protect the currency because depletion of foreign exchange reserves has never worked in terms of currency management. So if they sell dollars, typically money goes out of the system. And if they replace it with government bond purchases, it is fine. But then it's not a continuous, it's not a process because there is a limited amount of foreign exchange reserves, right? So clearly the outlook is not out. The current conditions of debt markets are very uncertain. And that's very largely because central banks have not communicated properly. They're not accepting the fact that it's excess money supply and low interest rates that is contributing to a large part of inflation. I'm seeing more and more, you know, analysis of some market commentators that it's beyond central bank policies, etc. Yeah, great. But then if it's beyond central bank policies, how is it well within central bank policies to print so much of money and determine the growth of the economy? So in both ways, it can't work in one way and not work the other way. So unless central banks act, uh, take policy and liquidity to levels which is more in which is more commensurate to how it can lead to a slowdown in demand, then that's the only way that inflation can come down, right? But then we will have to investors will we have to live with what is happening now. So how do you tide over the crisis? Then second is growing into the credit markets outlook. So credit markets too had a very good run, and that's largely because of the fact that government bond yields were so low, and there was enough money chasing higher yields. So in the global front, a lot emerging corporates were able to access dollar funding at very cheap rates. At Ray, and the funding was easily available, right? Like typical any time in a good time when equity markets are rallying, there's money, a lot of money, then the fundraising becomes much easier for corporates. And in India too, we did see a lot of uh, new issuers come to the market. But having said that, this time there's been uh, not so much of institutional money chasing these investors because mutual funds have turned completely risk averse after the DHFL and ILFS crisis and after what happened to Franklin Templeton. So they have not been funding the credit markets. To a very large extent, it's been the retail individual investors. So we have seen very large uh, issuance of MLDs, which has gone to the ultra high net worth segments. This year, I think MLDs issuances have crossed over 50,000 crores. Of that many, a lot of is GSEC linked. And these MLDs have enabled a lot of issuers to come to the market to raise funds from the uh, non-institutional segment of the market. And also a lot of other corporates have been able to raise funds to fund their growth. Then you have the new age fintechs that have come in, which are lending through unsecured loans through that through digital platforms, and they have been able to raise money. So in one way, it is good because a lot of money is loans have been going into normally sections of uh, borrowers who not traditionally go to the traditional avenues to borrow. The other way, this is causing a huge amount of risk because a lot of these guys are giving out personal loans and unsecured personal loans. And so hence, we don't know how they will behave once you, once the economy is not looking too good, right? And we don't have a track record as of now how the whole thing will turn when there is a bear phase. For example, if you had somebody had borrowed money to invest in cryptos, then how will they prepay? And it's highly possible. And many could have taken personal loans to invest in equities or just to spend, whichever. That's a different thing altogether, right? So credit markets at this point of time um, uh, have to be careful. Some, to a very large extent, balance sheets have improved. Um, Corporate balance sheets have improved. A lot of banks are much better positioned than that what way they were a couple of years back, because the commodity cycle has helped many companies to repay debt. Infrastructure companies have been able to restructure and repay debt. So a lot of NPAs that were NPAs have now gone out of that system. So bank positions are looking much better, much healthier. Most of the loans in the last many years, um, many have gone to retail rather than corporate. So even real estate loans have been very muted, given that real estate has been in a slump before slowly starting to pick up. COVID also contributed to the slump in the commercial real estate, etc. So uh, lot of muted lending. So on the institutional side, especially at the lenders banking sector, the balance sheets are pretty much comfortable, except for those banks that have traditionally gone into higher risk loans. The second is that, uh, having said that, the lending now has gone, as I said, largely to retail. RBI too has raised this issue in its financial stability report, and they have urged the public to check it out because they do see some kind of a risk in such large growth in retail loans. And as most of these are unsecured and not really mortgage loans, right? So even if and even if you really take, even more important is that given the competition in lending, even traditional gold loan companies like Muthoot and Manappuram are facing headwinds, largely because of the fact that the yields have come down. In fact, Manappuram did report very muted numbers, and they were mentioning that yields have come off very sharply, almost by 100, by 10%, uh, which is very huge in that sense. Still, the asset is not a problem because it's the most liquid of assets. But still, when yields are coming down, because so much of competition, that means there are so many lenders that are going chasing borrowers, whether it's gold loan based or whether it's unsecured. And when they chase borrowers, then the risk levels start to rise very sharply. So investors do have to watch out for this phenomenon. So that's on the second part. So just coming down, recapping the first one on the overlook headwinds. There are many headwinds in the interest rate market. So still not finished yet, even though the yields may have gone up very sharply. And many investors who were only staring at 6% in the last 2 years are suddenly seeing at 7.5 to 8%. And they'll think, oh, it's a great place to be in. Then on the credit markets, clearly the whole credit situation has improved in the country because the banks are much healthier than what they were. But having said that, a huge amount of loans have gone into the retail segment, and that could be a potential disaster. So that's something which investors have to really watch out for. And coming down to, so where to invest now, which is again a very tricky question, right? So we have seen now actually spreads have really come off. If you take Bharat Bond ETF, 10-year, it is at 778. And it's if you take it over the GSEC, it's just over 20 basis points over the GSEC. It's a very low spread. So would you rather buy the 10-year GSEC than the Bharat Bond ETF? Or a 10-year SDL, the latest cutoff came in at closer to 7.9%. So clearly, state loans are better than Bharat Bond ETF purely because uh, SDLs are repoable, and RBI does buy back SDLs if required. They don't buy back Bharat Bond ETF or a PSU bond. Then we go down to the AAA papers. Again, AAA 10-year AAA papers are closer to 8%. Not very, very um, not offering great spreads over the GSEC. Uh, then you also have even if you to go down the maturity scale. So you have 3-year GSEC at 7% plus. So anything over that 3-year corporate bond or 3-year, 5-year, 10-year are all in a range of between say 7.25 to 8%. If you look at the AAA kind of levels. So are these attractive? No, as long as the outlook for the 10-year GSEC is weak. If you if you don't want to buy the 10-year GSEC or invest in a 10-year gilt fund, then you might have to not look at the others as well because the spreads are way too low at this point of time. Going down the yield curve, you still have yields available. Like I was saying, we recently had a Tata Motors unsecured subordinate debt raising 10-year call bond or perpetual bond with a 10-year call at 9.3%. Now, this is just over about 180 basis points, 190, 80 basis points over the 10-year GSEC. The same bond a couple of years back was almost 350 basis points. So the yields here have not dropped, whereas government bond yields have gone up. So whether these yields will drop, it's a matter of question. So there is a lot of issuances, short-term, longer-term papers starting to come in a 8.5% to 10% kind of a band, depending on the issuer. Now, do these make sense? Depending on the issuer, depending on the maturity, shorter maturity bonds, if you can get it in a 1 or 2 year kind of time frame, getting it over 8.5%, 9%, it can one get you the returns as well as protect you against rising interest rates. The other way is to invest in the fixed income is to build out ladders. So you can invest in the long bonds. You can build 1, 2, 4, 6, 8, 10 kind of a ladder with less weights at the longer end. And as bonds mature, you can keep adding weights at the longer end with when yields start to rise. Or look at bonds that can be interest rate insensitive. Again, here you have to take some kind of you have to take some credit risk to invest. Now, if you look at the mutual funds category itself, the last 1 year has been very poor. Most of the funds are given really poor returns. Now, but having said that, with the yields going up, the portfolio returns itself are much higher now. Will they can they outperform over a 3-year period of time? Again, it's it's a very good it's a good principle, especially in fixed income, to make sure that you're investing in a mark-to-market product at closer to the end of a rising cycle, not at the beginning of a rising cycle, because the the loss in the loss in uh, the yields in the beginning years when interest rates rise, the loss in returns is difficult to make up over a longer period of time. Whereas if you invest at closer to a rising cycle, I mean, at the end of a rising cycle, then the gains can make up a lot of uh, gains can be really attractive and help protect against a lot of uh, uh, what- lower returns, you know, uh, as we go forward. So, uh, to some extent, uh, if you ask me, and the way I'm seeing it is that it's a bit inconclusive on where to invest. It really depends on the risk return. Clearly, I mean that's something which, yeah, if you want to take the credit risk, then it does make sense to invest in short maturity bonds yielding reasonable good rate. But if someone doesn't want to take credit risk and don't mind taking interest rate risk, should they invest? Um, now that's something which is debatable. Like I said, we are looking at 8% on the 10-year. The interest rate cycle uh, is just turning. So RBI is still only hike rates by twice, and there are a lot more to go. So, and the government borrowing is very heavy. So, and globally too, it's not looking too good. So all this put together, still going into duration products is carrying a good level of risk. So how do you calibrate the risk? I think the best way to calibrate this risk is to start laddering your portfolios. So invest in, like I was mentioning, maybe 1, 2, 3 years. You'll have to live with some low yields and low returns in the first year, but then this could help you uh, reinvest it and put more weights on longer bonds. And as those yields fall, when the interest rates have peaked, then that could really uh, boost your returns. With this, I will open the webinar to discussions. Um, any questions you have, any comments you want to pass, feel free to do so. Nikhil will open your unmute yours, and all of you can just unmute yourself and talk out or put your questions on the chat box.
If you have any questions, you can raise your hand. I'll unmute you, or you can even type it in the chat box.
Uh, uh, can I speak,
Yeah,
Arjun?
yeah. Hi.
Hi. Nice coverage, Arjun. Thanks for that. And the the I was just trying to think through what are the kind of levers for Indian inflation. I'm not talking about US inflation, where we have not done uh, so-called money printing here, and most of this macro sort of deficits or fiscal deficits, etc., has been uh, kind of range bound and sort of, so to say, in control. Where do you think our inflation is heading to, and what are the
Okay.
levers? What are the levers that are actually sort of pushing it up?
I think that it's to a large extent it's to do with if I were to say that um, it, it it is to a large extent to do with government spending as well, because if you really look at it, after COVID, the government took the fiscal deficit to 10.8 or 11%, right? And states too did that, right? So there was so much of an RBI, if you amount of money they gave to the markets were close to about 10 trillion or 10 lakh crores. That's the highest we have seen for a long period of time.
Yeah.
And rates were very low. So banks were flushed with liquidity. So where the inflation came from is too wrong. Yes, I mean, obviously on the commodity side, yes, food and fuel. But that more importantly, once the economy started opening up, right, and all the there was a whole host of loans going into the retail lending. That demand for goods and services really pushed up um, pushed up the prices. And just remember that a lot of prices are also to do with the fact that for a couple of years many had to make up for the losses that is that they didn't earn for the uh, during the COVID period time, right? So I mean, I couldn't break up the inflation and say this is what is caused by this, but I don't think that uh, the it's not due to the fact that RBI didn't print so much of money. They did print money because they have bought government bonds and they have taken FX reserves to $600 billion. So even if you take about $200 billion in the last, it's about 15 to 16 trillion rupees that is added on to the liquidity. A huge amount of money, right? And the government, with so much of fiscal borrowing and spending, because RBI was protecting yields, uh, um, that also has contributed to increased demand for goods and services. Very clearly uh, taking down to very basics of inflation. Uh, the increased demand and lack of supply is what causes inflation because prices tend to move up. So clearly, where does increased demand come from? Increased demand comes from some source. And this particular source this time was caused by giving money to the markets. And the supply clearly got constrained of a lot of factors. So that also, uh, so the demand suddenly increased and the supply did pick up. And supply is not looking to pick up soon, especially with this new crisis in the Russia-Ukraine front. So the only way to contain inflation now is to bring down demand, and that the central banks have to act proactively. Whether they can bring down the demand soon enough to curtail inflation, or whether it's going to be a function of the markets itself, where there'll be so much of losses in many assets that investments don't take off and no jobs getting created, etc. Then, so that's maybe a couple of years process. So I would say that India, I don't want to put numbers here. I would rather go with RBI forecast. They have raised forecast, but clearly, central banks clearly are post-script rather than not future-looking. So after the event has happened, they'll come and put out some data and statistics. So they're not a foresight. So I think you still have to live with maybe a couple of years of high inflation. Hopefully it's not structural in nature, and then it comes down.
Thank you.
Yeah, welcome.
If anyone have any queries, you can unmute yourself or put your questions in the chat box.
Sir, just one more question.
Sure.
What are those indicators that we need to track to see that, perhaps the inflation has peaked, or is it just what would be the indicators to track to sort of see where the
Yeah,
inflation?
no. It, I mean, going to individual components of inflation is it's not the easiest thing, right? Which is going to act up in one. But I think what's uh, what could be the thing is, at what level has the economy really stopped to, where the demand has come down at the aggregate level. I think that's the biggest tracker you need to check rather than looking at the individual components of inflation.
Any views on US inflation, sir?
Yeah, like I said, I think it's structural.
Okay.
They have printed too much of money. I mean, from $1 trillion to $9 trillion on a Fed balance sheet in 14 years with rates at 0 to 2%, clearly it's an excessive uh, printing. So unless they act fast and bring it down, it's not going to be easy for them. You can always have base effects and other thing, but
Yeah.
then the markets are not going to really, uh, embrace it, except for maybe short pullback rallies.
So interesting times. I mean, I've seen whatever limited experience I have seen, equity and debt both are doing negatively. I mean, both are seeing some kind of drawdowns or mark to market sort of.
Yes, yes. If you had come to my spaces a couple of days back,
Okay.
and which I've always been saying this, the biggest risk to the markets is US Treasuries. And
Okay.
government bonds have and are still the biggest risk to the markets now.
Mm.
Yes, you are interesting times. So the point is there is no safety here. There is no
Yeah.
hide.
There's no place to
Which,
hide.
yeah, correct. There's no place to hide. Yeah. Uh, anyone, any questions? We'll just take this opportunity to just talk about INR bonds. We are now completely, fully digital transactional platform. You can buy bonds, sell bonds. We have our own QuickInvest app where we curate bonds with the best primary, most information. Our own proprietary risk score. We showcase bonds that typically investors can understand, and also make sure that the bonds are outperforming every other asset class. We are many investors, financial advisors, uh, other transactors are using our platform for doing their bond transactions. We have if you're a financial advisor, we have a program for partnering, where we offer a huge amount of benefits on transactions. And if you're an investor, obviously we are we are connecting you to the market, making sure you get the best prices and the best bonds. If there are no questions, Nikhil, shall we close the call?
Yes, sir. There's nothing in the chats as well.
Okay, we can close the call. Thank you very much for coming.
Thank you, sir. Thank you.
Thank you.
Thanks. Thanks.